Lecture number 4. Non-deductible costs and expenses. The following costs and expenses are not deductible. Number 1. Different types of reserves and allowances. Number 2. Fines, financial penalties, and indemnities ruled against a taxpayer due to his or one of his affiliates. Number 3. The income tax due according to this law. Number 4. Interest paid on loans which exceed double the credit and discount rate declared by the central bank at the beginning of the calendar year in which the tax period ends. Number 5. Interest on loans and debts of different types paid to non-taxable or tax-exempted natural persons. Example 1. Interest on a loan used in the activity during year 2018 amounted to 20,000 livres Egyptian at a rate of 20%. Noting that interest on discount rate declared by the central bank at the beginning of year 2018 is 7%. Required, give the tax treatment. Answer: the allowed interest rate 7% times 2 equals 40%. Double the rate of interest and discount that declared by the central bank. Increase in interest expense not deductible equals cross multiplication 20,000 livres Egyptian based on 20%. Increase in interest expense that based on 6%. Then increase in interest expense equals 20,000 livres Egyptian times 6 over 20 amounted to 6,000. This increase in interest on loan used in activity is added to accounting net profit for year 2018 because it is not deductible. Example 2. From the preceding example, assume that the interest on the loan is at a rate of 13%. Required, give the tax treatment. Answer: as the rate of interest is within the double rate of credit and discount that declared by the central bank at the beginning of year 2018, 7% times 2 equals 14%. Then all the 20,000 livres Egyptian is deductible. Depreciation of plant assets. Depreciation of plant assets are to be calculated as follows, according to the requirements of the law. Number 8. 5% of the cost of procuring, constructing, developing, renovating, or reconstructing any building, establishment, ships, and aircraft for each tax period. Number 3. 10% of the cost of procuring, developing, improving, or renewing any of the intangible assets purchased, including goodwill, for each tax period. C. The following two categories of assets are to be depreciated according to the depreciable pay system at the rates corresponding to each. Number 1. For computers, information system, software, and data storage equipment, 50% of the depreciable pays for each tax year. Number 2. For all other assets, 25% of the depreciable pays for each tax pays. D. No depreciation shall be calculated for land, works of art, monuments, jewelry, and other assets which by nature are not depreciable. Depreciable pay. The depreciable value is determined on the basis of the balance for every group of assets at the beginning of the period, after adding assets purchased and all additions made during the year, such as the cost of transporting and installing the asset, and the repairs that add to the productive life of the asset and then deducting from it the value of assets disposed of or compensation for its loss or otherwise. This balance shall be treated as follows. Number 1. If the resulting balance is negative, this balance is added to the profit of the activity for the year, as it is treated as capital gain. Number 2. If the balance is £10,000 or less, it is fully charged to the income statement as depreciation and is deemed among the deductible costs of the same year. Number 3. If the balance is more than £10,000, depreciation is calculated for each group according to the percentage determined regardless the period of use of the group asset, and the remaining balance is carried over whatever its value to the following tax period as the basis for future depreciation. Example 1 on page 184 on your textbook. A merchandising sole proprietorship prepares its final accounts at December 31 each year. For the year ended December 31, 2016, the enterprise had the following transaction. Number A. On March 1st, sold computers for 25,000 livres Egyptian. B. On August 15, purchased new computers for 15,000 livres Egyptian. If you learn that the depreciation based on January 1st, 2016, the beginning balance amounted to 20,000 livres Egyptian, required to calculate the tax depreciation for the year ended December 31, 2016. Answer. Amounts in livres Egyptian. Balance at beginning of the year given 20,000 plus purchases of assets and all additions during the year 15,000, total 35,000, minus the selling value of assets or the compensations negative 25,000. The balance at ending of tax period amounted to 10,000. Then the tax depreciation is 10,000 as the maximum value allowed. Then the balance can be carried forward equals 0. Example 2 on page 185. From the preceding example, assume that the enterprise acquired new computers costed 27,000 livres Egyptian and sold computers for 8,000 livres Egyptian during the year ended December 31, 2017. Required to calculate the tax depreciation for the year ended December 31, 2017. Answer. Balance at beginning of year 0 that shifted from the preceding year 2016, plus purchases of assets and all additions during the year 27,000, total 27,000. The selling value of assets or the compensation negative 8,000. Balance at ending of tax period amounted to 19,000. Tax depreciation equals 19,000 times 50%, the depreciation rate of computers. Then the remaining balance that can be carried forward amounted to 9,500 livres Egyptian. Example 3 on page 186. From the preceding example, assume that the enterprise acquired new computers for 6,000 livres Egyptian and sold computers for 17,500 livres Egyptian during the year ended December 31, 2018. Required to calculate tax depreciation for computers and software for the year ended December 31, 2018. Answer. Amounts in livres Egyptian. Balance at beginning of the year that shifted from the preceding year 2017. 9,500 plus purchases of assets and all additions during the year 6,000 total 15,500 minus the selling value of assets or the compensation negative 17,500. Then the ending balance negative 2,000. As the ending balance is negative, it shall be added to the accounting profits of the activity of year 20 and 18 as it is capital gain. No balance can be carried forward to the next year. The negative ending balance means a capital gain realized. This capital gain, of course, is taxable. The initial depreciation for encouraging the replacement of machinery and equipment. 30% of the cost of the machinery and equipment used in production shall be deducted whether they are new or used at the beginning of each tax period during which such asset is used. The depreciation base shall be calculated for that period after the deduction of the said 30% amount. For calculating the depreciation base, 70% of the cost of machinery purchase is considered addition during the year of purchasing. Note: the deduction of initial depreciation requires that the taxpayer must keep proper accounts. Example on page 187 on your text. A manufacturing sole proprietorship prepares its final accounts at December 31 each year. At January 1st, year 2018, the depreciation base of machines and equipment was 30,000 livres Egyptian. On September 2018, the company acquired new equipment costed 50,000 livres Egyptian and sold machines and equipment for 10,000 livres Egyptian. So, if you learn that the company maintains proper accounts and the machines and equipment were used during 20 and 18, required to calculate tax depreciation that can be considered as deductible cost for year 20 and 18. Answer: initial depreciation amounted to the cost of equipment purchase 50,000 livres Egyptian times 30%, 15,000. Number 2, normal depreciation flow that calculated according to depreciable base. Balance at beginning of the year given 30,000 plus purchases of assets and all additions during the year. The remaining 70% of the cost of equipment purchased in year 20 and 18. 50,000 times 70% amounted to 35,000. Total 65,000. The selling value of assets or the compensation given negative 10,000. Then balance at ending of the tax period 55,000. Of course, this 55,000 amount exceeds 10,000. Then normal depreciation equals 55,000 times 25%. The depreciation rate of equipment amounted to 13,250. Added to the initial depreciation, then total taxable depreciation for year 20 and 18 total 28,250. Note: the remainder of the ending balance minus the normal depreciation that calculated on the base of depreciable base of 41,750 can be carried forward to the next year, year 20 and 19.